Most people think of the credit system as something that evaluates them, a judgment, a score that reflects their financial responsibility, a number that tells the world whether they're trustworthy with money. That framing is understandable, but it's not accurate, and the inaccuracy produces a specific kind of misuse that costs people real money. The credit system was built by lenders, for lenders. Its primary function is risk assessment, determining the probability that a borrower will repay a debt based on their historical behavior with debt. The credit score is a risk metric, a number that tells lenders how likely they are to get their money back, and therefore what interest rate they should charge to compensate for the risk of lending it. Higher score, lower perceived risk, lower interest rate offered. Lower score, higher perceived risk, higher interest rate required to justify the lending decision. The system is optimized for the lender's ability to price risk, not for the borrower's financial well-being. Understanding this changes how the credit system gets related to. Most people relate to their credit score as a reflection of their financial character. They feel good when it's high. They feel shame when it's low. They treat improving it as a moral project, evidence that they're becoming a more responsible person. This emotional relationship produces irrational behavior. People make financial decisions optimized for the score rather than for their actual financial position. Keeping a credit card balance because they've heard it helps the score? It doesn't. Avoiding closing unused cards because they fear the score will drop? Sometimes right, often wrong, and rarely the most important variable in the decision. Applying for new credit at the wrong time, before a major purchase, because they didn't understand how inquiries affect the score temporarily. The score is a tool with a specific function: access to credit and the rate at which that credit is offered. That's what the score actually does. It determines the terms on which borrowed capital is available. A higher score means cheaper borrowed capital, lower interest rates on mortgages, better terms on business financing, more favorable conditions on the debt instruments that fund productive financial moves. That's the financial value of a strong credit profile, not the trophy, the access, and the rate. Most people who interact with the credit system are doing so reactively, checking the score when something affects it, worrying about it before a major application, trying to improve it without a clear understanding of which variables move it and which don't. The people who use the credit system effectively interact with it proactively. They understand the mechanics, which variables matter, how they're weighted, what behavior moves them efficiently, and they manage those variables deliberately. Not to feel good about the number, to ensure the number reflects a profile that gives them access to the cheapest possible borrowed capital when they need it. The system wasn't built for them, but they understand it well enough to use it anyway. Most people know their credit score matters. Fewer understand what actually determines it, and the gap between knowing it matters and understanding what moves it is where most credit optimization goes wrong. Credit scores are calculated from 5 primary variables: payment history, credit utilization, length of credit history, credit mix, new credit inquiries. These 5 variables are not equally weighted, and the weighting is where most people's intuition about credit gets them into trouble. Payment history is the most heavily weighted variable, roughly 35% of the score in most major scoring models. Late payments, especially those 30 or more days late, damage the score more than almost anything else, and the damage persists for years. The single most important credit behavior is paying every obligation on time, every time, without exception. not because of the score specifically, but because late payments are the single most damaging event in the credit profile, disproportionately costly relative to every other behavior. Credit utilization is the second most significant variable, approximately 30% of the score. Utilization measures the ratio between the credit currently being used and the total credit available. A person with $10,000 in available credit carrying a $2,000 balance is at 20% utilization. Most scoring models reward lower utilization, ideally below 30%, with the best scores typically reflecting utilization below 10%. This variable is also the most immediately responsive to behavior. Pay down a balance, utilization drops, score improves relatively quickly, which makes it the most efficient lever for someone looking to move their score in a short time frame. The remaining three variables, length of history, credit mix, new inquiries, are less impactful individually, but matter in aggregate. Length of history rewards age. Older accounts in good standing contribute positively, which is why closing old accounts is often a mistake, even if they're not being actively used. Credit mix rewards variety. Revolving credit, credit cards, alongside installment credit, mortgages, auto loans, signals that the borrower can manage different types of debt obligations. New inquiries create a temporary dip. Each hard inquiry, triggered by applying for new credit, has a small negative effect that typically resolves within a year. The implications of this are practical. Don't apply for new credit in the period before a major borrowing event, a mortgage application, a business loan, when the score needs to be at its strongest. Understanding the weighting changes the behavior. Most people focus on the wrong variables, worrying about whether to close an old card, concerned about a single inquiry, missing the fact that their utilization, the second most important variable, is sitting at 60 or 70%. The efficient path to a strong credit profile prioritizes the highest weighted variables first. Pay on time, always. Keep utilization low. Let the history age. Don't apply for credit you don't need. Simple in principle, consistently under-executed in practice, because most people are managing the score emotionally rather than mechanically. If this is landing differently than you expected, subscribe. There's more coming. There's a specific behavioral pattern that emerges when people relate to credit scores as trophies rather than tools. They optimize for the number rather than for the outcome the number is supposed to produce. And that distinction, optimizing for the score versus optimizing for access, produces decisions that are technically credit conscious but financially irrational. The first common misoptimization is carrying a balance to build credit. This belief is widespread, that keeping a small balance on a credit card rather than paying it off in full demonstrates credit utilization in a way that improves the score. It's wrong. Paying the balance in full each month does not hurt the score. Carrying a balance doesn't help it, and at any meaningful interest rate, it costs real money for no benefit. The belief persists because utilization is a real variable, and people conflate utilization being measured with carrying a balance being necessary. Utilization is measured based on what the balance shows at reporting time, not based on whether interest is being paid. Using the card and paying in full each month demonstrates utilization without paying a dollar in interest. The second misoptimization is closing paid-off credit cards. The intuition is understandable. The debt is paid, the card is no longer needed. Why keep it open? Because closing it reduces available credit, which increases utilization on remaining balances, and removes history from the profile that contributes to the length variable. Both effects are negative for the score. Neither is catastrophic, but they're unnecessary costs paid for no financial benefit. The better approach, for most people in most situations, is to keep the card open, use it occasionally for a small purchase, and pay it off immediately. This maintains the available credit, preserves the history, and demonstrates utilization without carrying a balance. The third misoptimization is treating the score as the end goal. A credit score of 800 is not a financial achievement. It's a tool in a ready state. The financial achievement is what the score enables: the mortgage at a lower rate, the business financing on better terms, the access to capital that funds a productive financial move. An investor who has an 800 credit score and never uses it to access productive capital hasn't done anything with the tool. The score sitting unused is like a hammer that never drives a nail. The point isn't the score. The point is the access it provides, and whether that access is being used to build something. Most people's relationship with credit is either neglectful or misguided. Neglectful, not managing it at all, discovering the score matters only when it's needed for something important. Or misguided, managing it obsessively but for the wrong reasons, optimizing for the number rather than for the financial function the number serves. The more useful relationship is deliberate, understanding what the score does, managing the variables that move it efficiently, and using the access it provides at the moments when cheap borrowed capital advances the financial position. Not a trophy to be displayed, not a source of shame to be hidden, a tool to be maintained and used when the conditions are right. The credit system rewards a specific kind of participant. Not the most financially sophisticated, not the wealthiest, not the most disciplined in every dimension. The participant who understands what the system measures and manages those specific variables with consistent, boring, deliberate behavior over a long period of time. Deliberate credit management starts with a clear objective, not a target score, a target use case. What will this credit profile be used for? When will that use happen? What score is needed to access the best available terms for that specific purpose? Working backward from the use case produces a more focused management approach than working forward from the abstract goal of a higher score. A person planning to purchase a property in 2 years needs to know what score threshold accesses the best mortgage rates, and work backward from that threshold to identify what needs to change in the credit profile to reach it in the available time. The mechanics of deliberate management are straightforward. Pay every obligation on time, without exception. Set up autopay if necessary. Remove the human decision from the most critical variable. Keep utilization below 30%, ideally below 10% in the months before a major credit application. Don't close old accounts unless there's a compelling reason, an annual fee that isn't justified. Otherwise, let the history accumulate. Don't apply for new credit in the period before a major application. Each hard inquiry creates a temporary dip at the moment when the score needs to be strongest. And use the credit available. A credit card paid in full each month demonstrates utilization, builds history, and costs nothing. A card sitting unused builds history but demonstrates nothing. The deliberate user of credit also understands the strategic timing of credit applications. Applying for new credit when the profile is strongest, after a period of low utilization, with no recent inquiries, with a long history of on-time payments, produces better terms than applying at any other time. Better terms mean lower rates. Lower rates on productive debt mean more of the return stays with the borrower rather than going to the lender. The timing of when credit is accessed is as financially significant as the creditworthiness that determines the terms. A strong profile accessed at the wrong time, when it's been recently dinged by inquiries, when utilization is temporarily elevated, produces worse terms than the same profile accessed at a moment of maximum strength. The broader principle is treating credit as a financial instrument that requires maintenance and strategic deployment, the same way any other financial instrument does. A portfolio requires maintenance, regular rebalancing, intentional allocation decisions. A credit profile requires the same, regular monitoring, intentional management of the key variables, strategic deployment at the right moments. The people who use the credit system most effectively aren't doing anything complicated. They're doing a small number of things consistently and deliberately over a long enough period to maintain a profile that gives them access to capital on the best available terms when their financial moves require it. The system wasn't designed for them, but they've learned it well enough to use it on their own terms. Subscribe if this is the kind of clarity you've been missing. Like this if it changed how you see it.